Hey, EconoSite viewers, welcome to this explainer. Today, we're diving straight into the warning signs flashing just behind China's undeniable technological prowess. We hear about it all the time, right? Their booming artificial intelligence sectors, the shiny new robotics, the absolutely rapid expansion of their electric vehicle markets. But today, we're going to look under the hood at the hidden rust corroding that state-led growth and really examine the massive, hidden cost keeping it all afloat. Just take a look at this number, 300%. It's a staggering figure, and it represents China's total debt-to-GDP ratio, excluding the financial sector. This is a massive mountain of debt that has literally doubled since 2010. Honestly, it's a number that's keeping international economists awake at night. But to really grasp the scale of the issue here, we need to break down exactly what this means in practice. So, part 1, the mountain of debt. Let's get right into it. To understand why this massive number is causing so much global alarm, we really have to understand the debt-to-GDP metric itself. Like, why is this specific ratio the one flashing red? Well, measuring a nation's debt relative to its GDP is absolutely crucial because it tells us if the debt being taken on is actually productive or if the borrowing is simply outpacing actual economic growth. Think of it like running a business. If you borrow $1 million to build a brand new, state-of-the-art factory that permanently doubles your revenue, well, fantastic. That is highly productive debt. But if you borrow that exact same $1 million just to keep the lights on and pay your stressed-out staff while your revenue barely budges, you know you're in serious trouble. Measuring debt against GDP reveals whether a nation is actually investing in its future or just merely masking underlying economic stagnation. Moving right along to part 2, a global debt comparison. So, how does China's debt mountain actually stack up against the rest of the world? Well, when we project these trajectories out to 2026 across the top 6 major economies, a really stark divergence emerges. We're looking here at outstanding debt as a percentage of GDP. Now, Japan remains highly indebted over on the left, sure, but China's trajectory is climbing so aggressively toward that 300% mark. When you compare it to the other top major global players like the US, the Eurozone, the UK, and especially other emerging markets, China's current level of indebtedness puts it in a completely different league. They are climbing aggressively while the others are really beginning to level off. Now, I know what you might be thinking. The West unleashed a flood of stimulus during the pandemic, and that's absolutely true. But if you look at the total public and private debt as a share of GDP in the US, the UK, and the Eurozone, those ratios are actually dropping from their pandemic-era highs. Their borrowing is stabilizing. China, on the other hand, is speeding in the exact opposite direction. As we saw, its debt ratio has doubled since 2010, showing what seems to be an insatiable appetite for leverage over the past decade or so. Which brings us to part 3, drivers of China's debt. To fix an economic leak, you obviously have to find the source. And in this case, the everyday Chinese consumer is completely innocent. If you look at the breakdown of outstanding debt by sector over the past decade, the real culprits pushing this number up are corporate and government entities. Both have been expanding rapidly. Meanwhile, household borrowing remains incredibly weak. And this is largely because everyday citizens have been really battered by the recent devastating collapse in the real estate market. With property values plummeting, which is very often their primary source of wealth, consumer confidence is just shattered. The average citizen is tightening their belt, not taking on more loans. It's the state and the corporations that are carrying this massive load. Let's zoom in on that public sector slice for a minute. Nearly 40% of outstanding debt is now owed by the public sector, and that's driven largely by local governments aggressively funding favored industries. We're talking AI, EVs, robotics. To bypass their own borrowing limits, authorities are expanding what are known as local government financing vehicles, or LGFVs. Basically, these are off-balance sheet investment companies created by local governments to push infrastructure and keep these favored sectors expanding with low-cost state-backed loans. It creates a wild dynamic. For example, at one point, China had hundreds of registered electric vehicle companies, all fueled by this cheap local money just competing for dominance. They're essentially utilizing massive state borrowing to try and buy their way into future technological supremacy. And over on the private side, the situation is incredibly stark. Chinese companies are simply borrowing vastly more than they're actually selling, which highlights a really severe disconnect between debt and productivity. Just listen to this metric from Capital Economics. Business debt has doubled, grown by a staggering 100% since 2019, while revenues are only 30% higher. When your debt doubles in a few short years, but your revenue growth is lagging that far behind, you are taking on water way faster than you can bail it out. And that leads us right into part 4, crisis or stagnation. With a debt ratio that's increased by more than 120% of GDP over just the past 15 years, what comes next? Does this lead to an explosive financial crisis? Or is it going to be a slow, agonizing stagnation? Well, the answer lies in the vicious cycle currently trapping the Chinese economy. Step 1. State-owned banks lower their lending standards to artificially prop up economic growth targets. Step 2. Creditors continuously roll over loans just to keep struggling, unprofitable firms afloat. We're talking about zombie firms here, companies that basically only exist on paper because state banks just keep tossing them financial life preservers. In fact, right now, nearly 1/3 of these companies are actively losing money. And step 3, this traps massive amounts of capital, preventing it from flowing to healthier, innovative borrowers, and it directly worsens domestic overcapacity. They're churning out products that simply aren't selling. And the direct, unavoidable result of that overcapacity? Deflation. Because of this endless state support for manufacturers at the expense of consumers, China has been suffering from deflation for 3 straight years now. This excess supply drags down prices across the board, resulting in literally the longest streak of deflation since the country transitioned to a market economy back in the late 1970s. But hold on, before we start assuming a total economic collapse is imminent, experts do point out that this is not an immediate Lehman Brothers-style situation. Thanks to remarkably high domestic savings, really strict capital controls, and the simple fact that the state completely dominates the financial sector, the risk of a sudden overnight implosion is heavily mitigated. I mean, they recently survived a major stress test with a property market crash without the entire banking system freezing up. So what we're witnessing here isn't a sudden explosion, but rather a slow, grinding structural decay. Mark Williams from Capital Economics has a quote that I think literally hits the nail on the head regarding the tragic irony of this whole situation. The very mechanisms Beijing is using to artificially save jobs and hit arbitrary growth targets are exactly what's hollowing out the economy with unproductive capital. By refusing to let unhealthy companies fail, the state is effectively dragging the healthy sectors of the economy right down with them. So as China grapples with this entrenched overcapacity and slowing momentum, we have to wonder how long an economy can use debt to mask the illusion of growth before the foundation permanently cracks. Can a state-led growth model actually survive its own mountain of unproductive debt? It's a massive question, and it's one that will undoubtedly shape global economics for the next decade.